Something big is breaking. Today we are going to talk about something that almost no one in mainstream finance wants to admit is happening. Something structural, something irreversible, and something that could completely redefine the price of silver for an entire generation. Because right now, beneath the surface of the markets, vaults are draining, deliveries are being challenged, and the system that has controlled silver prices for decades is starting to crack. This is not just another rally. This is not a temporary spike. And this is definitely not just speculation. What we are witnessing looks a lot more like a physical stress event, one where the paper silver market is colliding head-on with physical reality. Shanghai is tight. Comex has been shocked. London inventories continue to bleed. And the question investors everywhere are now asking is no longer if silver breaks higher, but how far it can go. Could silver realistically move toward $100 an ounce? Let's break this down step by step, using the data, the mechanics of the market, and the signals that are flashing right now. Part 1, why this move? In silver is different. Silver has rallied before. We've seen excitement before. We've heard bold predictions before. So what makes this moment different? The answer is simple but uncomfortable. This time, the physical market is leading, not the paper market. For decades, silver prices have been set primarily through futures contracts, derivatives, and leveraged paper claims. These instruments created the illusion of abundance even when real metal was scarce. But now the physical side of the market is pushing back, and when physical demand overwhelms paper supply, price discovery changes fast and violently. We are seeing that process begin. Silver has already posted one of the strongest multi-month advances in its modern history. Not in a slow grind, but in aggressive, momentum-driven moves that have forced traders, banks, and industrial buyers to reassess risk. This isn't a chart pattern, it's a supply problem. Part 2. Paper silver versus real silver, the core flaw. To understand what's happening, we need to talk about the foundational flaw in the silver market. There are two silver markets, the paper market, the physical market. In the paper market, Comex futures, LBMA unallocated accounts, ETFs, silver exists mostly as a promise. These promises are heavily leveraged. At times, there are dozens or even hundreds of paper claims for every single ounce of deliverable silver. As long as most participants settle in cash, the system functions. But the moment too many players want actual metal, the system strains. And that strain is now visible. Think of it like a warehouse issuing receipts for goods it doesn't fully have on hand, counting on the fact that most people, one, show up at once. Silver is approaching that moment. Part 3. Shanghai. The East is flashing red. Let's start in the East. The Shanghai Futures Exchange has become one of the most important indicators of physical silver demand globally. Unlike Western exchanges, Shanghai is far more focused on actual delivery, not just financial settlement. And right now, inventories there are extremely tight. Stocks have fallen toward levels that historically coincide with stress in the physical supply chain. When Shanghai inventories compress like this, it sends a very clear message. Buyers want metal now, and they are willing to pay up to get it. This tightness doesn't stay local, it ripples outward. Arbitrage windows open, premiums rise. Physical metal gets pulled from wherever it can be found. And very often, that metal comes from Western vaults. Part 4. Comex, the delivery shock. Now, let's talk about what really shook the market. Comex. Comex is where most of the world believes silver pricing happens. Futures contracts trade in massive volume, giving the impression of deep liquidity, but only a small fraction of those contracts ever stand for delivery. That's why what happened recently mattered so much. A huge delivery request came in, representing a massive percentage of the registered inventory. Registered inventory is the silver that is supposed to be available for delivery. When a single delivery event removes a large chunk of that supply in a short time, it exposes how thin the buffer really is. This wasn't normal activity. This was a stress test, and Comex barely passed. The market took notice. Because once confidence in easy delivery disappears, participants start asking dangerous questions. What if the metal isn't there? What if delivery delays increase? What if cash settlement becomes encouraged? That's when price control becomes very difficult. Part 5. London. The slow bleed. No one talks about. Now let's move to London. The LBMA is the heart of the global bullion system. And for years now, its silver inventories have been trending lower. Not collapsing overnight, but steadily declining. That's important. Because slow, persistent drawdowns tell us something critical. More metal is leaving than entering. Even when inventories rise temporarily, the long-term trajectory remains down. London has effectively been acting as a physical backstop for global demand, feeding Asia, industry, and investment flows, but no backstop lasts forever. And the thinner London becomes, the more fragile the entire pricing structure gets. Part 6. Lease rates, the smoking gun. Here's a signal most people ignore, but they shouldn't. silver lease rates. Lease rates represent the cost to borrow physical silver. When silver is plentiful, lease rates stay low. When silver becomes scarce, lease rates spike. And recently, lease rates moved sharply higher. That tells us something critical. Institutions were scrambling for physical silver. They weren't speculating. They weren't trading paper. They needed bars. And they were willing to pay a premium to get them. Lease rate spikes are rarely random. They usually appear before major pricing dislocations. Part 7. India. Buying at any price. Now let's talk about demand, real demand. India is one of the largest silver consumers on Earth. And what's happening there is remarkable. Despite rising prices, Indian silver imports have surged again. Not slowed, not paused, surged. This demand is coming from investment demand, jewelry demand, industrial use, solar manufacturing. And when a price-sensitive market like India continues buying aggressively at higher prices, it sends a powerful signal. Silver is being treated as essential, not optional. That kind of demand doesn't disappear on a pullback. It accumulates. Part 8, industrial demand. Silver is being consumed. Unlike gold, most silver demand is destructive. Once silver is used in solar panels, electronics medical applications, EVs, it is rarely recovered. That means silver supply doesn't just need to meet demand. It needs to exceed it just to stay balanced. And right now, it doesn't. We are running structural deficits. Mine supply is flat. Grades are declining. New discoveries are rare. Meanwhile, industrial demand keeps growing. This is not a cycle. It's a squeeze. Part 9. The macro backdrop. Debt, currency, confidence. All of this is happening against a dangerous macro backdrop. Exploding sovereign debt, currency debasement, rising geopolitical risk, erosion of trust in financial systems. Silver thrives in this environment, not just as an industrial metal, but as a monetary escape valve. When confidence breaks, investors move from promises to things, and silver is one of the few assets that is tangible finite. Affordable essential, that combination is powerful. Part 10. The feedback loop, reflexivity. Here's where things get explosive. As prices rise, investors pay attention, physical buying increases, inventories tighten further, premiums rise. Paper confidence weakens, that pushes prices higher again. This is reflexivity, and silver, because it's a smaller market, reacts faster and harder than gold. Once momentum turns physical, it doesn't stop politely. Part 11. 2 prices for silver. We are already seeing signs of a bifurcated market. One price, futures, price, ETF, price, screen price. Another price, physical bars, immediate delivery, real-world availability. When that gap widens, the paper price eventually has to chase the physical price higher, not the other way around. Part 12. Could silver really hit $100? So let's address the big question. Is $100 silver possible? From a historical perspective, adjusted for inflation, silver has already been there. Relative to gold, silver remains deeply undervalued. Relative to money supply growth, it's still suppressed. From a structural perspective, physical supply is tight, demand is non-negotiable. Paper leverage is extreme. A move toward $100 wouldn't require mania. It would only require loss of confidence in paper silver, and we are closer to that than most people realize. Final thoughts. This is not a trade, it's a transition. This isn't about calling tops or bottoms. This is about recognizing a transition from paper dominance to physical reality, from price management to supply-driven discovery, from complacency to urgency. Silver isn't just moving, it's breaking free. And once that process begins, history shows it doesn't stop quietly. If you found this breakdown valuable, make sure to like, subscribe, and share this video. Because what's happening in silver right now isn't being explained honestly anywhere else. Stay informed, stay grounded, and as always, watch the physical market.